Investing can be like navigating a jungle. Your circle of competence is your compass. Stick to industries you understand. Focus on businesses you can easily analyze. Knowing your strengths is key to successful investing. Ignore what you don't understand. It's okay to pass on a hot tip if it's outside your expertise. Your circle of competence will keep you on track. Remember, slow and steady wins the race. So, you know your circle of competence. Now what? It's time to find those winning stocks. This is where a stock screener comes in. A stock screener helps you narrow down your search. You can filter by industry, market cap, and more. Using a stock screener saves you time and effort. It helps you zero in on the most promising companies. Remember, a stock screener is just the first step. You still need to do your homework. Let's talk profit margins, specifically gross profit margin. This tells you how much profit a company makes after paying for its goods or services. A high gross profit margin is a beautiful thing. It means the company has pricing power. A strong gross profit margin is a sign of a healthy business. It suggests that the company can weather economic storms. It also indicates that management is running a tight ship. And that's what we're looking for. High gross profit margins are great, but what about expenses? That's where SG&A comes in. SG&A stands for Selling, General, and Administrative Expenses. These are the costs of running the business. You want SG&A to be low, ideally no more than 30% of gross profit. This shows the company is efficient. Low SG&A means more money drops to the bottom line, and that means more profits for investors. Section 5. Investing in the future. Now, let's talk about R&D. That's research and development. This is where companies invest in their future. Think new products, innovative technologies, and groundbreaking research. Look for R&D expenses to be at or below 6% of gross profit. A balanced approach to R&D is key. It's about staying ahead of the curve. Section 6. Understanding depreciation. Depreciation is the decrease in value of an asset over time. Think machines, equipment, and buildings. It's a non-cash expense, meaning no actual cash is going out the door. You want depreciation to be less than 10% of gross profit. Low depreciation suggests the company is investing in its assets. It can give you insights into the health and efficiency of a business. Section 7. Managing debt wisely. Debt. It's not always a bad thing, but too much debt can be risky. The interest-expense ratio tells you how much of a company's operating income is going towards paying interest on its debt. You want this ratio to be low, preferably less than 15%. Low debt levels give companies more flexibility. They can invest in growth or weather economic downturns more easily. Section 8. The bottom line. Net earnings. Net earnings. This is what's left over after all expenses are paid. It's the profit that belongs to the shareholders. You want net earnings to be strong and growing. Look for net earnings to be greater than 20% of total revenue. Strong net earnings are a sign of a healthy and profitable business. Focus on the bottom line. Net earnings. Section 9. Earnings per share growth. Earnings per share, or EPS, tell you how much profit is allocated to each outstanding share of a company's stock. You want to see consistent EPS growth over time. This shows that the company is becoming more profitable on a per-share basis. Consistent EPS growth is a strong indicator of a company's long-term earning power. It suggests that the company is on the right track. Section 10. Building a strong foundation. Congratulations, you've learned how to use the income statement to identify promising long-term investments. These filters are your secret weapons. They help you separate the wheat from the chaff. But remember, the income statement is only one piece of the puzzle. Next, we'll explore the balance sheet and cash flow statement. Stay tuned, and together we'll master the art of fundamental analysis.